Katerina Simonetti. She's at Morgan Stanley Private Wealth Management. She's a private wealth advisor over there. Katerina, again, I'd love to hear kind of the conversations you're having with your clients as you close out a pretty successful 2024 and think about next year. How are you talking to your clients these days?
Well, Paul and Caroline, thank you for having me on the show. This is a really important conversation because it's not lost on clients that we've had double-digit returns for 2 years in a row, and it is only reasonable to expect that the returns in 25 are going to be somewhat subdued. So clients are concerned. The questions that we're having about how to capture returns in the portfolios, how to maximize the income in the portfolios, and most importantly, risk management in the upcoming volatility. And to be fair, our expectations for the year are not dim. We think a lot of emphasis is on Fed and inflation and how all the other factors are going to play out. But when it comes to the practical things that we do before the year end, rebalancing the portfolio and achieving maximum portfolio diversification in stocks, bonds, real assets, and private investments is the absolute key.
So, Katerina, I mean, again, a lot of folks are saying, boy, can you have a third year of performance in the equity markets? And to the extent you want to be a little bit more cautious, boy, you can look at the fixed income market. How do you think about the fixed income trade? Do I sit there in a 2-year treasury and get, 4.3% from the U.S. government, or do I take some credit risk?
Well, Paul, if we are expecting that Fed is not going to have quite as many rate cuts as originally expected, it's not necessarily the absolutely worst thing in the world for fixed income investors. Number one, we're going to get higher yields of cash for a little bit longer than expected. And two, if we don't think about fixed income as per se a trade, but as a hold and as an asset that delivers that consistent income and risk management, because on the risk-adjusted basis going into 25, we prefer bonds over stocks. We think it's going to generate yield, but quality, very much so within bonds as well as stocks, is going to be the name of the game for 25.
Volatility, because there's so much, lack of clarity as it currently stands. Katerina, just take us through the thought process over at Morgan Stanley Private Wealth more broadly as to whether or not the Fed will cut more than 2 times. What sort of realistic inflationary pressure will we get from the talked about tariffs that are yet to be imposed?
Caroline, where do I start? Uncertainty about the Fed, uncertainty about inflation, uncertainty about the tariffs and immigration, as all these headlines are going to start coming out in early 25. All of this is going to play a role. And so our expectations for the early half of the year come with the expectation of the higher volatility. And last couple of weeks gave us a bit of a taste of what's to come. Now, we tell investors not to chase rallies. And this is the other side of this coin, where we have to prepare and stay calm and make sure that we have high quality portfolios, focus on sectors that generate yield, focus on the areas like financials, industrials, materials, and make sure that we take some profits off the table and avoid higher concentrations in the portfolios. We've had some fantastic performance. This is the time to take some gains.
But the problem is you had fantastic performance in 2023. And if you'd had that mindset around an NVIDIA or the Mag 7 then, boy, did you miss that rally of 2024. NVIDIA's up 180%, let's call it, for the year. So how do you talk some of your clients out of that FOMO feeling that a lot are going to be feeling all over again when it comes to quantum and AI?
Caroline, it's only natural to feel this way. And I think that what we have to ask are the valuations and profit expectations that are on the table, as well as the fact that Fed has a lot of pressure on them, when it comes to inflation in terms of cuts. Are we going to get as many cuts as expected? That is the big question for us and for them. So when investors are looking at their holdings, of course, it is natural not to be missing out on the continued growth. So we don't advise selling out of the entire position, but healthy profit taking and diversification into the other areas where the growth of that level didn't occur yet, and where the possibility of future growth are significantly more substantial than they are in technology in some of these areas that achieved remarkable growth in both 24 and 23.
Katerina, how do you talk to your clients about alternative investments? I'm thinking private equity, private credit, hedge funds, because when I speak to RIAs, I'm really surprised that the high percentages they allocate to alternatives. How do you guys at Morgan Stanley think about it?
Well, in the time where investors are so concerned about the risk and volatility and protecting the values of their portfolio, having the asset class that could hedge the risk in the equity side of the equation, it's extremely valuable. Now, it comes with a cost, and that cost is liquidity. So investors that are comfortable with giving up some of the liquidity in their portfolios are perfectly fine using the alternative investments because it has huge value, with and making sure that we achieve consistent risk-adjusted return. But with that, it's just a piece of the puzzle where fixed income delivers income, equities deliver growth, cash delivers liquidity, and alternative investments are extremely effective in risk management.
We're going to have some changes to the tax policy, it seems like. We'll see how that plays out. Then that kind of goes to the asset class of municipal bonds. I'm a big fan of municipal bonds. A triple tax-free treatment is I think, a good and wonderful thing. How do you guys position municipals in a typical portfolio?
Well, taxes are a major concern, and inflation is a concern as well. But when investors are looking at their portfolios and analyzing the after-tax income and after-tax performance that they're receiving, tax efficiency is something that is a part of every single conversation that we're having with clients. And this is where municipal bonds come into play. Now, with municipal bonds, you have to make sure that the tax equivalent rate of return that we're getting on muni bonds is actually as good or better that return that we can achieve in corporate fixed income, because there are some amazing buying opportunities on that side. But investors certainly like having that tax-free cash flow in their portfolios, especially in retirement.
Taxation clarity is something that perhaps the crypto world is potentially yearning for, gurning for 2025. How have you thought about crypto and that particular area of potential investment, alternative investment for the 2024 into 2025, Katerina?
Well, Caroline, when you think about the development of crypto world, right, turned from something that we don't mention or talk about into something that was, the most exciting part of the portfolios, then the most volatile part of the portfolios. And now we're seeing more of a legitimization or the use of crypto in the normal portfolios, with availability of ETFs, with people feeling more comfortable investing, in this type of investments. But they can't lose track of the fact that the volatility still remains extremely high. So the positioning in the portfolio has to be extremely careful. And investors that are relying on crypto for liquidity certainly have to have that in mind, because the volatility in equity markets is high, but our expectations for volatility in the crypto world is significantly higher than that.
And meanwhile, though, going back to the equity markets, where there's still going to be some volatility, I'm interested in your overweights, industrials, utilities, and software. And actually, that software shift from hardware to software, from chips into a Palantir or to a software application of generative AI has been a theme we've been hearing. But talk a little bit more about the industrials and utilities. What drives that for 2025?
Caroline, we're looking for defensive plays. We're looking for companies that are not just delivering attractive earnings outlook, which is something that we see across the board. And of course, we'll be looking across the board, for 25, but also that bring to the table attractive valuations that didn't have that explosive growth that some of the sectors we're seeing. So that's where the industrials, that's where the materials, that's where consumer staples come in. We're looking for qualities and also for companies that are in position to make money, to be profitable in 25.
All right, Katerina, thank you so much for joining us. Always appreciate getting some of your time and your thoughts on these markets. Katerina Simonetti.